let's talk here a little bit and do some exercises. And the first one I want to do is exercise 13-2, which is a held to maturity bond investment. And it says that on January 1st, 2013, Kelly acquired bonds with a face value of $500,000 for $483,841.79, and that's a 10% effective annual interest rate. And the bonds have a 9% stated interest rate, and they pay interest semi-annually. And those amounts are due on June 30th and December 31st. And so we want to prepare the journal entries to record the purchase of the bonds and the first two interest receipts using both the effective interest method and the straight line method. And so let's do that here. And so we purchased these bonds on January 1st, 2013, so 1/1/13. And it's going to be classified as a held to maturity debt security. So we're going to have investment in held, I'm just going to call it held to maturity securities. And we paid $483,841.79. And we paid cash for that investment, and so we're going to credit cash for $483,841.79. And so these bonds sold at a discount, and that initial discount is going to be $16,158.21. And so we're going to do the effective interest method over here, and I'll do the straight line method over here. So when we do this, the bonds become due December 31st, 2016. So we have 2013, 14, 15, and 16. They're 4 years, semi-annual. That means that there's 8 periods. And so what we're going to do is we're going to take the discount, and that discount is $16,152.21 divided by 8 periods. We're going to amortize $2,119.78 each period. And so remember, we also have to figure out the coupon amount, and so let me just do that. So we're going to receive each period cash, and that cash is going to be, remember, $500,000 multiplied by the stated rate, 9%, divided by 2 because it's semi-annual, $22,500. Oops. Let me make that a little bit clearer. $22,500. And so that's my coupon payment. And the amount that I'm going to increase the asset by each period is the amount of amortization. Let me just get rid of that a little bit. So investment in held to maturity securities. The asset account, $2,019.78. And that means interest income is going to be $24,519.78 each period. Now, because this is a straight line method, it's easier, and that's going to be the journal entry every period until these bonds mature. And at that point, the investment in held to maturity securities should have a balance, 483, 841, 79 cents, right? And each period is going to get $2,019.78. We'll do that 8 times, and this will have a balance at the very end at maturity of $500,000. All right? And so the straight line method is easier. The problem, remember, is that the cost of debt, the effective cost of debt, is not going to be constant through the life of this bond. All right, so now let me do the effective interest method, and we'll do it for the first couple periods to make sure that we have that down. And so when we do the effective interest method, right, the journal entry to record the purchase of the asset is the same. It's still going to be investment in held maturity securities 483, cash 483. The cash that's received each period is still the same, $22,500. That doesn't change under straight line or effective interest. It's still the coupon payment. What's going to change, though, is that we're going to figure out interest income, and that is what's the driver of the journal entry. Remember, under the effective interest method, interest income is the carrying value, which is 483, the initial carrying value, 483, 841.79, multiplied by the effective interest rate. Remember, the effective interest rate on this was 10% per period, but remember, it's semi-annual, so I'm going to divide it by 2. And so my interest that first period is going to be $24,192.09. So $24,192.09. That means, right, investment in held to maturity securities, this is a plug figure, right? And so I'm going to get to this in a second, but it's going to be $1692.09. So this is an important part about the difference between the effective interest method and the straight line method. You know, when we do the effective interest method, the amortization of the discounted premium is the plug figure. It's the difference between the cash received and the interest income, which is computed by the carrying value times the effective interest rate. Under the straight line method, interest income is the plug figure because the cash is calculated and then the amount of amortization is the straight line amount. And so interest income is the plug figure. So it's important to recognize this for both Chapter 13 and 14, the difference between these two. All right, so there is exercise 13-2, and we're going to move forward here and do some more problems, and I'm going to stop and we'll pick up with another problem.